if you think about that with a carry trade, situations where you're losing money, where you're forced to reduce risk, that's happening in a world where volatility is spiking. So in a world where basically everyone is trying to reduce risk. So the cost of kind of managing your leverage in that world can be quite high. That's the unique part of it, is that the drawdowns happen at really bad times, really expensive times to have to close your positions, and things can get away from you, I think, especially fast. Whereas you might have drawdowns at times where, other people are not drawing down, and therefore it may be easier for you to kind of manage the leverage in that sort of situation. You're not having everyone looking to reduce risk at the same time.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Larsen.
Hey everyone, and welcome back to another edition of Top Traders Unplugged, where today Robert Carver and I are joined by Kevin Coldiron, who is a co-author of the book The Rise of Carry, which we'll be diving into today. But first off, Kevin, thanks so much for joining us. We have very much been looking forward to our conversation. How are you doing? How are things where you are this morning?
I think the world's a little very unsettled, but I'm sitting here in California. It's a nice sunny day, so relatively speaking, doing well.
Yeah, no, absolutely. Now, before we dive into all the juicy topics that we're going to discuss, I would like to set the stage for our conversation, partly so that the audience knows a bit more about your background, and also, if you're able to, perhaps a kind of a brief introductions of your two co-authors, Tim and Jamie Lee, just so we can all kind of frame the conversation and put the book into a better perspective.
Okay. Well, personal background, I started work initially at the New York Federal Reserve back in the days when the U.S. actually tried to control the value of the dollar by intervening in the foreign exchange markets. I worked as an analyst on the foreign exchange desk there in New York, so I got to see kind of firsthand the power and influence of central banks early on in my career. I ended up doing a MBA at London Business School after that, and then got into the world of quantitative finance. I worked for what eventually became BGI, Barclays in London, and started off in the quantitative research team, kind of building models to take positions in markets, and then eventually moved over and set up a hedge fund business. My insight was, hey, we've got all these great models. We're just using them at the moment to take long positions, but actually there's a lot of power on the short side. Let's set up a hedge fund to exploit that. And I ran that business in London in the late 1990s, and then realized, hey, I'd be better off doing this on my own. And I moved to San Francisco and partnered with Peter Algert, who was the head of U.S. equity research at BGI at the time. And so we started a hedge fund business in 2002, Algert Coldiron Investors. Our strategy was long, short, quantitative equities. So we traded kind of all markets around the world, developed an emerging. And we were using quantitative models, but kind of longer term quantitative models on the, holding periods on the order of kind of 6 to, 12, 15 months. So not high frequency in and out type of things, really trying to systematize the insights of fundamental analysts. So a lot of the inputs into our modeling was accounting data, but we also used some kind of volume and price stuff. But I did that until 2014, and then I ended up selling my stake in the business back to Peter. And since then, I've been teaching at Berkeley, the business school in Berkeley, and they have a master's in financial engineering program. Basically, the students are, very highly skilled in the quant space. A lot of them have advanced degrees in math and computer science, et cetera. And then they use the program as a tool for getting into finance. So I teach a course on asset management in that program.
Very exciting. Must be fun for them to actually have someone teaching them that's done it as a practitioner. And of course, I'm spoiled today because I have two authors with me who are both practitioners, which is, not that often you see people write about stuff they've actually done in practice. So I'm thrilled about that. In terms of your co-authors of the book, Tim and Jamie Lee, do you want to give a little bit of their background, Kevin, just so our audience know what their background might be or angle to the book?
Yeah, happy to do that. And Tim and Jamie are related. Jamie's Tim's son. And Tim I met many years ago. He ran a consultancy called Pi Economics. So Tim's a macroeconomist. And we were a client of his. So he had a consulting firm where he would write on strategy and markets. And most of his clients were big macro type traders, and we weren't that at all. But I really liked his the way he viewed markets, and so we tried to kind of take his macro view and embed that in not so much in our alpha forecasts, but in how we managed and calibrated risk in the portfolio. So Tim had been writing about the importance of carry trades, I think, before anyone else. He was really talking about the influence of the yen carry trade back in 2005 and 6, and identifying that really we had entered this carry regime well before we even had that term. Right. And so when I left my firm in 2014, I kind of called up Tim and said, "Hey, I really think all the stuff about carry you've been writing would make a great book." And he said, "Well, as it turns out, I've already got kind of an outline and a plan to write one with my son, Jamie, who I hadn't met before. But Jamie is a volatility trader. So he's, in some sense, Tim's got the big macro picture. Jamie is actually kind of managed and traded in the volatility markets, and now works for Jeremy Grantham, the GMO founder. In a personal capacity, works for his foundation. So he helps kind of on the asset allocation side, and then manages a sleeve of money for him trading volatility. So it's a nice combination because you've got Jamie, who really understands the guts of the microstructure. Tim is a macroeconomist, and then I kind of fit in the middle. And we talk quite a lot in the book about institutional incentives to engage in carry trades, and I kind of have seen that firsthand from my perch as a hedge fund manager for a long time. So that's the three of us.
Yeah, no, the great background and great to have three kind of different people come together and write one book. So let's talk about the book. Let's dive in.
I should just say, Niels, that to be clear, of the three, I'm the least intelligent of the three. So just to set expectations in terms of,
I thought it was.
Niels, we've got the wrong guy on the podcast. Were the other two not available?
I thought the British were the humble one, right? But here we have an American just saying, no, exactly. Well, there we are.
He worked in London for too long, that's why.
That's right.
Excellent. Rob, why don't you take the lead on diving into this book, The Rise of Carry, which, by the way, I highly recommend that all our listeners should get and read for themselves, of course.
Definitely. I found it a very interesting book as well. And I've got a not dissimilar background. I've done a bit of volatility trading myself. Obviously worked in systematic hedge funds. And a long time ago, I learned some macroeconomics, which I've unfortunately mostly forgotten. So my questioning on the macro won't be perhaps that incisive. But let's start with the absolute basics. Let's start with the definition of the term carry and carry trade. We're both in the education business as well. So whenever I try and teach my students about this, I generally start with FX carry because I think that's the one that's easiest to get your head round. So do you want to kind of explain to us the sort of setup and perhaps the characteristics of an FX carry trade?
Yeah, absolutely. So conceptually, carry trades we think of as, and we talk about this in the book, as a trade that makes money when nothing happens, right? So what does that mean? It means that, let's say in the FX world, if you borrow money in a low interest rate currency, which is, let's call it the yen or the dollar, and then use that, convert it to a high interest rate currency, let's call it the Turkish lira. So you borrow at 0% and you convert it to another currency and you deposit it in a bank, and you earn 10%. If nothing happens, right, if the world stays the same, if the exchange rate doesn't move, then you're making that 10% yield spread, right? So that's that yield spread, that income that accrues to you if nothing happens is the carry. So that's the basic setup. Now, that trade has certain very important characteristics. One is it is short volatility, which is basically another kind of a fancier way of saying you make money if nothing happens. So if the world stays the same, doesn't move, volatility is very low. If, on the other hand, things change, volatility emerges, then the probability of you losing money starts to grow. And typically, these trades involve money flowing from kind of a low risk environment to a high risk environment. So when volatility rises, typically the high risk currency or asset tends to depreciate. So that trade is short volatility. In times where volatility spikes, carry trades lose money. Our definition is that carry trades are always involve leverage. So it always involves borrowing. So just a long position unlevered in, say, a high dividend yield portfolio would not be a carry trade, even though that makes money when nothing happens. You earn the dividend yield. But our definition is that carry trades are always involve leverage. They're liquidity providing. So in other words, money is flowing where liquidity and capital is abundant to where liquidity and capital are needed. So there's a lot of capital and liquidity in Switzerland or Japan. You borrow there, you invest in Turkey where interest rates are higher, there's a need for capital. So as carry is growing, market liquidity rises, it becomes easier to trade and easier to borrow. And then the last feature of a carry trade is that it's got what we call kind of a sawtooth return pattern. In other words, long periods of positive returns punctuated by occasional large drawdowns. So in the currency example, the exchange rate between, let's say, the yen and the Turkish lira is mostly stable. Indeed, as carry trades grow, the lira might even appreciate as money flows in. But Turkey is a risky place. And when volatility emerges, you can get a sudden flight out. And so you get a steep drawdown. So you get these kind of patterns of, people call it escalator up, elevator down, right? And that elevator down emerges typically at times of crisis. So it carries a risk that is in some sense hard to diversify because it's emerging when everything is going bad.
Yeah, there's quite a lot I'd like to unpick from that answer, definitely. I guess the first thing to say is that the sawtooth return pattern, another way of describing that is like negative skew effectively, isn't it?
Correct, yes.
Yeah. So the other thing that's kind of interesting to me is with the one of the things we talk about a lot on our podcasts is the difference between volatility and risk. And I think in a lot of financial markets contexts, risk is kind of thought of in a symmetric fashion. So, the classic way of measuring risk is with a standard deviation, which of course is a symmetric measure of a distribution in which, a high upside is seen as bad as a high downside. But in that FX carry example, a high upside on the trade obviously isn't a problem, right? It would be great if the lira appreciated by a surprising amount. You'd absolutely love that. But generally the risks are actually skewed to the downside. The risk, when the world gets more volatile, the Turkish lira does not tend to appreciate versus the yen. So that's kind of, although theoretically you could argue that the FX carry trades not necessarily kind of short risk in the general sense, because some risks are good for it. But in a realistic world, it's kind of a short vol trade, right?
Exactly. That's exactly right. Yeah.
Yeah. So maybe we could talk about a slightly different example of carry trade then, which is kind of more pure kind of short vol, and that would literally be something like, selling VIX futures or, paying variance swaps or, shorting straddles in the options market. That kind of carry trade.
Yeah. So, if you short VIX futures, as you said, that is, you are literally selling volatility or selling applied volatility. And so that's that's a carry trade in the sense that the typical shape of the VIX futures curve is upward sloping, right? So the 1 month forward volatility typically sits above spot volatility, and so on. So you have this term structure of volatility that's typically upward sloping. So a way to a kind of a carry trade in that world would be shorting VIX futures and then just kind of rolling down the curve, right? So if you short a 4 month VIX future, in 4 months it becomes spot VIX. Spot VIX trades below 4 month forward volatility. So there's that roll, the return you get for rolling down that curve is the carry, right? If the world stays the same, if nothing changes, if the shape of the VIX term structure stays the same, then you make money rolling down the curve. And of course, you lose money if short-term volatility spikes. So if you were putting that trade on a month ago, you'd be losing money right now because the the VIX has spiked. And
you're talking to somebody who did have that trade on last month. And it is now closed.
Exactly. And the thing is, it may have been closed voluntarily or it may have been closed forcibly. And that's the thing. If you're, in a leveraged position that's short volatility, then you lose control of your future because if you lose money, you get stopped out or you're forced to close your position. And that can kind of reinforce the movements in the short term, a kind of vicious leverage cycle that I'm sure your listeners are all familiar with. So yeah, that's kind of a pure volatility carry trade. I think it's quite interesting, and we try to explain this in the book. My son read the book and he said, some of these charts, Dad, no one's ever going to understand. And one of those happened to be one that I developed, which was trying to show that if you looked kind of when we started our careers back in the 80s and 90s at the returns to a currency carry trade strategy, that they were pretty orthogonal to kind of the general movement in volatility globally. But in the last 20 to 30 years, the returns to a currency carry trade have been highly correlated with the sort of volatility carry trade that we just talked about. In other words, these carry trades, the kind of risk factor has kind of merged into kind of a single global risk, which is really centered on the S&P 500 and the VIX. So a lot of carry trades are short vol, and that vol is really represented now by the VIX, I think.
Yeah, and we really saw that in 2008, right? Because, there were all these, where I used to work, we had a fund of hedge funds business, and there were all these hedge fund styles that were supposedly uncorrelated. And, when the metaphorical tide went out, it turned out there was an awful lot of those guys who, weren't wearing bathing suits, as the metaphor goes. And actually, they had a lot of their returns under the hood were basically carry related. So the correlation was much higher than you thought it was.
Precisely. Yeah. And, it's tough as a hedge fund manager. I've seen that myself and you have in your career and we talk about this in the book, the incentive structures of a lot of the asset management world, hedge funds in particular, make it very challenging to have a negative carry trade. You're incentivized to have positive carry because with positive carry, you make money most of the time, right? So, you can show your boss your P&L is positive. If you make money 4 out of 5 years, you collect a bonus 4 out of 5 years. Your firm collects an incentive fee 4 out of 5 years. And then, when you have the drawdown, when do the drawdowns happen? They happen during times of generic spikes in volatility where you can say, well, that was out of my control. Like everyone's losing money. It's not me. Don't fire me. Nothing I could do. So, It's tough. Those incentives matter. Those agency issues are very important, and so it's not surprising that professionals have migrated toward trades with that kind of carry profile, given the way that they're paid.
Yeah, it's interesting because Niels and I are more on the momentum end of the spectrum, which is a bit more like a positive skewed strategy, which means you have the exact opposite experience. You spend much of your time explaining to clients why you're in a drawdown and hoping they'll hold on for the the period when the 1 year in 5 or whatever it is when you actually make money. So absolutely. Let's just kind of dig in a bit more about. So I can understand that any leveraged trading strategy is inherently more dangerous than any unleveraged trading strategy, right? Because you've always got the danger that you're going to be forced to stop out, close your positions when you don't want to. And everyone always says that, if only I'd been allowed to hang on for a bit longer, then I'm sure the LTCM guys were saying that right back in 1998. If only I'd been able to hold on for a little bit longer, it would have all come back, right? But what is it about because obviously you can run any number of strategies in a leveraged way, and we're futures traders here, so we're always using leverage, right? We've got no choice. We're inherently using leverage. But what's uniquely different about the leverage in the carry trading strategy that makes it more toxic, do you think?
Well, I guess I would turn it back to what the underlying economic risk in a carry trade is, which is short volatility. So you have a levered position. The key risk factor is what happens to volatility. So in a levered position, as you said, you run the risk of being forced to close out, and that means trading regardless of impact. You have no choice. So if you think about that with a carry trade, situations where you're losing money, where you're forced to reduce risk, that's happening in a world where volatility is spiking. So in a world where basically everyone is trying to reduce risk. So the cost of kind of managing your leverage in that world can be quite high. That's the unique part of it, is that the drawdowns happen at really bad times, really expensive times to have to close your positions, and things can get away from you, I think, especially fast. Whereas you might have drawdowns at times where other people are not drawing down, and therefore it may be easier for you to kind of manage the leverage in that sort of situation. You're not having everyone looking to reduce risk at the same time.
Maybe that's the benefit of mostly being in a drawdown all the time, actually, as a trend follower. Probably the only benefit I can think of right now. But I do want to pick up on this point, because I think it's important. Why would this risk be different or more toxic? I think that's a great question, and I wanted to ask you this, Kevin. That is, so volatility obviously plays a key role in releasing the risk of the carry trade. Let's call it that. And if we go back in history, I would argue that volatility just used to be a measure. We just used it as a measure. We looked at it and it was a measure. But now volatility is in all of our models. It's in all of our parameters. It's a key component. So when it does change dramatically, it seems like it hurts a lot more people, or there's a lot more people who suddenly have to react at the same time. So I wanted to hear your thoughts about this transition of just the term volatility and the role it plays in investing, and maybe sort of your thoughts on whether it's that transition that makes it or increases the toxicity of the carry trade.
Yeah, that's a very good point. And it almost kind of edges into philosophy at some stage, right? Because there's the first moment of returns, which is kind of the mean, and then volatility is supposed to be kind of a function of how the return evolves. But as people trade volatility itself as an asset or an instrument, you could argue that kind of the tail kind of wags the dog in some sense, right? Like
or a parameter, Kevin. I would say an or a parameter, right, where it triggers us to change position. First, certainly in our world, right, where everything is kind of position sized according to volatility.
Exactly right. So let's kind of walk that logic through a little bit and think about, say, maybe a risk parity type of strategy where, where positions are scaled according to some measure of typically historical volatility, but maybe in your world it's forward-looking volatility. Either way, those two things are fairly correlated. So if whatever measure of volatility you're using changes, your model changes, you use that to then scale your positions up or down, which in turn, if enough people are doing that, actually impacts the historical evolution of the return, which then feeds back into your measure of volatility. So I do think you're absolutely right that that's a change probably that we're only seen, I'd say, in the last maybe 10 years in scale. And so, yeah, returns, I think, now are at least in part driven by this kind of volatility sizing behavior by traders and by long-term investors. So it's no longer just kind of this independent output. It's part of the system.
Yeah. Rob, I'll let you continue.
Yeah, I was also thinking that maybe Carry's got something in common with similar type strategies in things like, say, equity long short, where when you have an effect over time where the trade gets crowded, more people get into it, and the edge in the trade gets reduced. So I guess if you think about, say, piling into an emerging market currency that's got a high yield, the currency might appreciate, but at the same time, it's quite likely the interest rate differential ratio will narrow, right? Because, there's going to be a massive demand for bonds issued by, say, Turkey, and therefore the price is going to rise, and therefore the yields are going to fall, and the actual interest rate differential will reduce. So I kind of have this mental image of lots of people kind of getting into this crowded theatre, and the marginal person coming in having to pay more and more for their ticket, right? But they're still going in. This is the thing that's quite remarkable, that people still pile into these trades. Again, we can go back to 2007, where people were still piling into trades where, they were selling protection on credit, say, for basis points, for almost no premium at all, because heck, it was completely safe, right? And it couldn't possibly go down in price. So I wonder if that's another kind of characteristic of the carry trading strategy that makes it inherently more risky.
That it's more likely to be quote unquote crowded than other trades. Is that what you're saying? Or I just want to make sure I understand your...
Yeah, no, I think it's more about the relationship between so whenever we see a sawtooth pattern of returns, that's probably due to a pattern of people going into a trade, the trade getting crowded, and then if anything goes even slightly wrong, and because of the effect of leverage, the rush for the exits is much bigger than it would be if A, the trade wasn't crowded, and B, there wasn't leverage on to begin with. But then I guess the other thing that's going on is that the sort of returns available from the trade are getting smaller as more and more people pile into the trade.
I got you. So the marginal investor, the one who is going to lose money first, is also the one who's come in, when the yield spread, the carry is most narrow, kind of at the end.
And maybe that's actually what makes the trade more susceptible to a break point, right? Because you've got a whole bunch of people who just come into this trade who are earning almost nothing. So it doesn't take much of an adverse movement for them to start losing money and having to cut their positions. Whereas the guy who's been in there for 3 years and has been earning a yield spread of 5, 6, 7, 8, 9, 10% is still okay with it.
No, I think that's a great point. And that people have talked about the kind of only takes one grain of sand in an unstable pile to get the cascade going. So that I think you're right on that. I hadn't actually thought about it in those terms, but the marginal investor has far less room for error in the carry trade than maybe in other trades. And given that there's underlying leverage, that adds to the fragility. I think that's a good point. Yeah.
Yeah. So this quite neatly brings me actually onto the next thing I want to discuss, which was, for me as a former sell-side vol trader, so basically a market maker in the volatility markets in interest rates, for what it's worth. And one of the sections in your book I found really interesting, and I've honestly never seen before, was this analysis of the kind of feedback effects of people trading options, obviously selling options to earn carry, to earn option premiums effectively. and the effect that has on the actual level of volatility. Because you use this, your subtitle of your book is The Dangerous Consequences of Volatility Suppression and the New Financial Order of Decaying Growth and Recurring Crisis. But so that this idea of the carry trade actually, suppressing volatility through the kind of interactions of market participants is something I found, really interesting. So perhaps you could. I've not explained it very well. I'm hoping you can explain it a bit better.
No, it's interesting. As you were saying that, I actually was starting to think about your previous question. I think the two are linked. So, selling volatility, is a carry trade. If you think about, the kind of crudest way to, if you're just selling an option unhedged, it's a bet on, the implied volatility in the options price being higher than ultimately the realized volatility. So that's that's just short volatility trade. You can delta hedge that as well, and kind of transfer some of that volatility risk to the counterparty, the delta hedging counterparty. But either way, if you think about what's happening as more people come into that trade where they sell volatility, what effect will that have on the levels of volatility? It will push them down, just like anything else, right? So if you think through that process, the kind of marginal person who enters that volatility selling carry trade will be coming in at a very low level of volatility getting pushed down. That's what we mean by volatility suppression. The growth of carry trades has a tendency to push the level of volatility down, but then it also increases fragility. When you have a spike in volatility, then the margin for error in that marginal trader, as you just said, is a lot less, and you can get the process reversing. What we talk about in the book, I'm kind of jumping a little bit, is if you think about what the central banks have done over the years in intervening to stabilize markets. Well, what happens when central banks intervene? The focus is always on interest rates and QE, but at a macro level, the big impact is that it stabilizes volatility, and oftentimes volatility comes down quite dramatically after central bank intervention is announced. So that has the effect of, kind of truncating losses for carry traders, right? If carry is short volatility spikes during a crisis, that's very bad for carry traders. Fed intervention has the impact of capping that volatility and pushing it back down. And indeed, the expectation that the Fed is going to intervene keeps volatility at low levels generally. So central bank intervention has helped truncate losses for carry traders in a crisis, which in turn makes carry trades look more profitable because we never observe the full left-hand tail of that distribution, right? So it's like when you're calibrating, how much, do I want to do this trade? How much risk should I put in this trade? How correlated is it with other things? You're doing that based on a distribution that's been influenced by the suppression of volatility from central banks, which encourages more people to do the carry trade, which in turn creates more, so if you kinetic energy for volatility in future crisis, more potential for it to spike, which necessitates bigger interventions, and you have this kind of ratchet process through time.
It's funny to sort of sit here and listen to you and talk about these things, and especially the kind of the currency carry trades, which are really the first ones that I can remember. And it was incredibly popular in Denmark back in the 80s and early 90s. I mean, it's just one of those things. And another thing that people did a lot of back then was just selling straddles, so especially on the FTSE. I don't know why, but I remember these firms popping up with these incredibly, looked amazing, stable track records, right? And then every 2 or 3 years, they would just completely blow up. And And, and I certainly remember also early on in my career having been involved in just sort of sitting there and selling straddles on the German Bund, hoping that it would more or less stay stable, which of course it did for the most of the time. But when it didn't, it was pretty nerve-wracking. But I want to, well, first of all...
You're an old school carry trader then.
Oh, yeah, well, and now completely in the other camp, right? I don't like...
It's like they say, there are old traders and there are bold traders, but there are no old, bold traders. So yeah. Niels used to be bold, but now he's old.
Yeah, definitely went from the convergent to the divergent side of investing, that's for sure. And it's also funny, actually, in the sense that I think we've had maybe, I don't know if you can say that, but certainly one of the ultimate carry traders we've actually had on the podcast, because a name that might be familiar to you, Kevin, that's Nick Leeson.
Of course.
He was on the podcast, and of course he, for various reasons, in a sense, probably not that he planned, but he really did become the ultimate carry trader, selling all his straddles on the Nikkei back in the 90s, I think it was. But I wanted to go somewhere slightly different, although it could involve the central banks, as you kind of alluded to also. But I wanted to ask what your thoughts are in terms of the role that carry trades may play in financial bubbles. How do you see, are there any relationship? Do they create the bubbles? Do they make them bigger? Or how do you see that?
We talk about the world entering what we call the carry regime. The carry regime is a world where carry trades aren't just done in foreign currency markets, but they grow. They're done in the options markets. They're done, we think of private equity as essentially being a carry trade, buy to let property being a carry trade. So we see them everywhere. And what that means is that, again, going back to the characteristics of a carry trade, what are they? They're leveraged trades that provide liquidity. So in a world where carry trades are expanding and growing, debt is growing, right? Leverage is growing, and so is liquidity. So in some sense, as that world expands, if you will, the bubble. So the short answer to your question is yes, I do think they're involved in financial bubbles, and I'm trying to kind of describe how we see the mechanism. So in that world where the bubble or the carry regime is expanding, initially that looks like a pretty good world, right? Because liquidity is enhanced, and by liquidity I mean the ability both to access capital, so to borrow, and also to transact in financial markets. So both those things are improving, and the world looks good. At the same time, it's increasing levels of debt, which is putting downward pressure on interest rates and inflation. And it creates this illusion that certain financial assets are almost as good as cash, like money substitutes. So you have a world where inflation, it's kind of a deflationary world, low interest rates, people, aren't very attracted to holding cash because it yields nothing. But financial markets are very liquid and easy to trade. And so they substitute cash holdings for holdings in financial assets. And here I'm thinking of money market funds or corporate bond ETFs, a variety of things that, because they seem very liquid and they offer higher yield, are good money substitutes. But remember, all this carry trading is short volatility. So when volatility spikes, carry trades lose money, risk emerges, and people no longer, people no longer are happy to hold those money substitutes. They no longer see corporate bond ETFs as a money substitute. They no longer see money market funds. They just want treasuries or they want bank deposits. And so that you get a kind of a flood out of these money substitutes back into true cash. And I basically see that carry as helping kind of accelerate financial bubbles through this creation of, or helping grow leverage and liquidity, but then also making the contraction of the bubbles more severe through this mechanism of, flooding out of money substitutes when liquidity disappears. So another long answer to a, a question, but it's quite important actually that this mechanism, because I really think that's what we've experienced in the last 30 years ago. And 2020 was, quite a clear example of that, where all of a sudden, no one wanted to hold, money market funds or short-term bond ETFs. And I think that's why it was absolutely critical that the Fed, critical in the sense of it showed just how important this money substitute effect is when the Fed said they were going to buy corporate bonds, because they understood those things were being packaged as basically money substitutes. And if they didn't underpin that market, there was just going to be, a kind of
meltdown.
There wasn't going to be enough money around to meet the demand.
I mean, they're actually buying the ETFs as well, which surprised people, right? They weren't even buying the underlying. Well, they were buying the underlying bonds, but it was the whether they were buying the ETFs because they felt that was the most efficient way of doing it, or whether that was a specific area of the market they were trying to fix. I don't know actually.
I think it's both. I mean, the discounts to NAV on some of those corporate bond ETFs were massive. I think they were trying to do both.
Let me ask you a question that you can answer with a short answer, Kevin, or at least try to.
I try to.
Are we currently in a carry regime, yes or no?
I think we're transitioning. I think we still are in the carry regime, but we may very well be moving kind of in the final phases of it. A lot of carry trades haven't been that profitable in the last decade or so. The currency carry trade, not that profitable. Even volatility selling in the S&P 500 hasn't been profitable, depending on how you set it up, in the last 5 years or so. And, we do say that the end of the carry regime will probably come through some form of inflation, which we're starting to see. So I think we could be in the early phases of maybe transitioning to, out of the carry regime. You think about in the past, 2008, 2020, what has the macro environment looked like when there was a big central bank intervention? Typically low inflation. Now, if we had a market crisis and you've got inflation already at 7 or 8% and the Fed intervenes, then all of a sudden it doesn't become crazy at all to see inflation expectations really becoming unhinged, right? Because it's one thing to pump a ton of liquidity, print a lot of money in a world where inflation's 0. You do that in a world where inflation's 7 or 8%, and maybe you really do push yourself into a completely different world, different regime. Now, I'm not saying that's going that's going to necessarily happen, but I don't think it's out of the question by any stretch.
Yeah, I mean, one of the things we talk about quite a bit is the fact that central banks, especially over the last 15 years, ostensibly central banks are there to kind of help, the man on the street or the woman on the street. But of course, generally their interventions since 2008 have mostly been helping, Wall Street, the financial economy rather than the real economy. So I guess that's an example of that dilemma, that the tools the central banks have and the objectives they have, even without going forward, like right now, as a central bank, there are clearly areas of the real economy that are still in a pretty bad state. And yet, ostensibly, inflation's here. The tools we've been using to help the real economy, we now need to reverse in a way that will probably reduce asset prices, probably reduce inflation, but could do untold macroeconomic damage. So, but I'm getting off topic. Let me try and steer that as back to carry. So, I guess in a similar vein, what's the kind of mechanism or transmission mechanisms by which carry, which we've talked about really as this kind of something that happens in the financial markets. Most people on the street aren't going out and doing carry trades. Like there aren't kind of housewives in Iowa doing straddles on the German Bund like Niels. What are the transmission mechanisms by which carry can change the economy and potentially damage it and cause problems if, for example, we have, one of these sawtooth down movements in carry, which it sounds like you're kind of seeing happening now?
I think the main mechanisms through the S&P 500, which we say has kind of become the center for the global carry trade, right? So if the volatility of the S&P 500 is a carry trade, which it is, right, behaves in that sawtooth return pattern, escalator up, elevator down, It basically means the S&P 500 follows that same pattern.
Let me stop you there, Kevin, because I can see the direction you're going in, and it's
Right.
It's not. I've obviously asked the question wrongly, so that's kind of a pure wealth effect, which is potentially important because households do have stocks on their balance sheets. But in your book, you actually talk in more detail about the creation of money within the banking system and how that's related to carry. So maybe I should have been clearer in saying that that's the question I want answered. So yeah.
So, okay. I was going to say, that we claim that the flow of causality is from the S&P 500 to the real economy, as opposed to what we're typically taught, which is that the stock market reflects what's going on in the economy. We think the economy reflects what's going on in the stock market. And I would argue that's more than just a wealth effect, because it triggers central bank intervention. It triggers, exactly what you just talked about, the creation of money, and the impact on inflation. So I would argue that the S&P 500 is the global carry trade. When it has drawdowns, when it has this negative skew, there's the wealth effect, also forcing kind of the hand of the central bank, leading it to intervene and create more liquidity and potentially more possibility for inflation down the road. So that's kind of how we see the carry trade flowing into the real economy.
Okay. And what about sort of extending that model to cross-border flows? So what effect does the carry trade have in terms of cross-border flows, both pure money flows, but also in terms of investment?
Yeah, it's kind of fascinating because, we've talked about the currency carry trade in very trader terms, right? Because we're all traders. But increasingly, we see this kind of carry trade operating at much longer horizons. So you get, Chinese firms issuing dollar debt and then converting that to RMB, and in some cases just lending on the RMB. But in a more macro sense, you get firms issuing low interest rate dollar debt, converting that to their local currency, and then using that to invest in projects that earn local currency cash flows, right? So the acceptance, the willingness to accept that currency risk, that volatility risk, allows for a whole range of projects in higher interest rate countries to get done where they wouldn't have got done if they had to be financed at higher local interest rates. So that's kind of the quote unquote good part about carry, in the sense that it's creating, while the carry regime is expanding, it's creating more growth, more money flowing to emerging economies, more cross-border flows. But then it introduces that exchange rate, that volatility risk into that cross-border flow mechanism, which makes it more fragile. So, when we get these carry spikes, volatility spikes, then you get those flows can reverse quite quickly, and you can get contraction in growth outside the U.S. or outside low interest rate currencies very quickly. So volatility in emerging market currencies, that's one of the indicators that we said in the book could point us toward, are we moving out of a carry regime if we start seeing kind of extreme volatility in emerging currencies, which you could argue for certainly in the case of Turkey, we have now Russia. So I think that's another indicator that the stability of the currency regime is kind of reducing quite a bit these days. So I think we are in a kind of a transition phase from that point of view. But yeah, the carry regime does have a big impact on cross-border flows for sure.
I mean, one question I was going to ask in a bit, but I'll ask now if that's okay with you,
Sure.
Niels. You've given me one example of when the carry trade is a good thing. It's building power plants and dams perhaps overseas that otherwise wouldn't get built. Can you give me any other examples, or are you just so down on the whole thing that that's the only one you can think of?
Well, the example that I think is most easy for a lot of people to understand, but again, it might end up being kind of a negative, is there's a big growth in cross-border mortgages in Europe, right? And when the Swiss agreed to peg the Swiss franc against the euro, there was a lot of people who took out mortgages in Swiss francs and used that to buy houses in Hungary and Poland. And a lot of people could buy houses who couldn't afford to buy houses if they had to pay local interest rates. Unfortunately, the Swiss changed their mind and the currency appreciated by 25% overnight. And so you had a whole range of people who no longer could afford to pay back their mortgage. So I suppose in the end that ended up being, not a good thing, because they then had to be, kind of bailed out, or they had to default. So I suppose in the end, I'm suspicious of the, quote, good side of the carry trade, because I suspect that the full risk of, exchange rates or volatility isn't embedded in the calculations of the people who are taking out the low interest rate loans and using them to build power plants. Maybe they are. And certainly some people are sophisticated enough to do that, but I suspect in the end that risk isn't fully embedded into the projects.
So you don't take the kind of Greenspan-esque view of 20 odd years ago, which is that derivatives are good because they allow risk to be transferred between people who don't want the risk to people who do want the risk.
Yeah, I mean, I'm sure there's plenty of that happens, but I think what we're talking about is a world that's moved on dramatically since then, and so I think selling options is a form of conditional leverage. Like you're saying, I'm going to use my balance sheet to in certain conditions. If the put finishes in the money, then as a seller of the option, I have to be prepared to use my balance sheet to make good on that. So there's just a whole bunch of contingent liabilities out there in the system related to derivatives that we really don't have a handle on. And I just can't believe all those contingent liabilities are kind of fully funded, or that won't result in risks emerging that haven't been properly priced. So yeah, I guess I'm a bit of a skeptic on the Greenspan view of the world.
I wanted to pick up on the topic that you just discussed here between the two of you. I mean, I think it's pretty clear that there are a lot of forces out there who really cheers for carry, not least central banks in their action. But also, if we go back and we look at, and I don't know exactly when we can pinpoint the beginning of it, but clearly guidance from central banks and narrative and conditioning of investors have become, I think, more and more clear that that's taking place, and it kind of underpins the whole carry world. And of course, carry in itself is something that I think humans can relate to, because it's this thing about you can make money by doing nothing, right? What could be better than that? And because actually I'm very worried of what could happen next because of all of this, because of the actions that's been taken to quote-unquote stabilize markets, the narrative that we've been told. And I think some people who maybe haven't been in the markets as long as we have only seen this kind of, Fed put and buy the dip and all of that stuff. And then on top of that, you can add, crypto and all of that stuff. So what I'd like to hear from you is, if we think that the carry regime is starting to lose its grip, and I don't know if there's been other periods historically, you may know this, Kevin, but there's other periods where it's been definitely a carry decade or two and then something else comes. But I'm interested in your view as to what comes after a carry regime. What does that regime look like? I'd love to hear both of you what you think.
So I think the central contradiction of the carry regime is that central banks appear to be all-powerful when in fact their grip on the markets is slipping away. So in the short term, when they intervene, they stabilize markets, buy the dip works, more people do buy the dip, more people do carry trades. But that's just requiring bigger and bigger and bigger role for the central bank. And when we have a crash where the central bank isn't able to stabilize volatility, let's say we have a world where we've got 7% inflation, the market crashes, central banks intervene, they pump a lot of liquidity, and markets continue to go down. Then you have a really dangerous situation where you've created a huge amount of potential inflation, you haven't stabilized the markets, and I think that's very possible will happen in the next crash. So we've got a world where everyone's going in thinking that central banks are all powerful, but in fact they've created the tinder for a fire that they won't be able to put out. So had they actually been less interventionist, they might have retained their influence. But I think they've now set up a situation where, I think about the equity market, right? Since 2020, what's happened to credit spreads and what's happened to the VIX? Credit spreads relative to their history are very, very low. And that makes sense because the Fed has said, hey, the credit markets are now under our protective umbrella. Whereas the VIX, a measure of equity risk, has not fallen back in the way it typically does after a crisis, which suggests to me that, the market's worried that equities are not under that protective umbrella. So I think in the next crash, that is going to be tested, right? The credit markets are going to be expect to be supported. And then if the equity markets aren't, it leaves them in a politically very dangerous situation because it's like, hey, how come you've bailed everyone else out, but not, the person who's put money in their 401k? So I think the next stage is whether or not the Fed will make good on that explicit promise to bail out the equity markets. And if they don't, then you really get an eruption of volatility combined with higher inflation. So I think that's the next stage. So I think a non-carry regime world is going to involve much higher and sustained higher inflation and a loss of credibility of a central bank, which ultimately might mean kind of rethinking the role of a central bank.
So before I hear from Rob, so just because maybe I don't know financial history as well as you do, Kevin, but would you say that there has been periods like this where you could classify it as a carry regime and it's come to an end? Or would you say historically it's probably more like high or low inflationary period that kind of describes this because maybe we didn't think in the carry terms back in the 70s or back in the 40s or whenever we last had some quote unquote crashes that took a while to overcome?
Well, when you were saying your question initially, there was a point I wanted to make, which is that carry, I'm talking about it in very negative terms, and I should be careful because some amount of carry is absolutely critical and socially good, right? Banks do carry trades. They're levered positions that provide liquidity, and we need that. Insurance companies selling insurance is also a form of carry trades, and that makes everyone better off if a well-capitalized insurance company sells. Insurance allows us to transfer risks, et cetera, and even derivatives to some extent can serve that purpose. So certain amount of carry trading is good. It's when it becomes too big that it creates the fragility that we're talking about. So if we look through the history, our view is that we really started the carry regime either in 1987 or 1984 with the introduction of S&P 500 futures, and it accelerated in 1998. If we look back before then, we didn't have the integration of global markets. We didn't have all the, financial, we didn't have derivatives. It was much harder to do carry trades. It was more limited just to banks. So I don't think we've seen the kind of carry regime in the past that we're experiencing now. I don't think it's in the data kind of before the 80s.
Right. And that actually makes it even more dangerous, in my opinion, because most people will not have seen this. Like most people who now manage large sums of money have never experienced what it's like to manage money in an inflationary period, right? So it kind of ties in together. Rob, what are your thoughts, Rob, on this? I know we have to kind of slightly start to think about winding down. We've already kept Kevin more than an hour, but...
So I recently reread the book about a biography of Jesse Livermore, who, of course, as you know, was a stock trader in the early part of the 20th century. And I immediately thought 1929. Because going into 1929, the amount of leverage that people could get on stocks was even higher than today. I mean, you could go out and buy stocks at like 20 times leverage. It's absolutely crazy. And the central bank definitely did not intervene after that. And in fact, arguably, the US central bank, prolonged the depression because they were very much believers in, quote unquote, sound money. So they were not interested. So worst case scenario is that we are looking at 1930s. Against that, a couple of hopefully bright spots. One is that governments stop looking to central banks to do all the work that fiscal policy ought to be doing as well. I think that's a big problem. I think, governments have sort of allowed the central banks to be the people who are always bailing them out, which means they don't have to do unpopular things with taxes and so on. So maybe the balance between monetary and fiscal policy will become better. Whether there'll be time to kind of sort that out if we get a kind of crash, I don't know. But that's what I would hope would happen. We shouldn't just be relying on the Fed. The second thing, really briefly, is I do wonder if this is more of a US story than a European story, because the number of stocks in household balance sheets, I think, is higher in the US. So, for example, in the UK, a lot more pension plans are more heavily weighted towards government bonds, say, for example. Stock ownership is generally lower in most European countries than in the US. So, obviously, what happens in the US affects the rest of us anyway, but I do wonder whether that transmission mechanism is potentially more of a problem in the US than it is in this country. I think in this country, the link between, for example, the UK and Denmark have some of the highest levels of household mortgages than any other country. So in those countries, what the central bank does in terms of the transmission mechanism on mortgage rates is potentially more of an issue. But anyway, there you go. That's my brief answer to your question, Niels.
Yeah. Any comments to Rob's thought there, Kevin, before I give you my last question?
I was going to say one thing earlier, and when he mentioned what the central bank is trying to do with their intervention in terms of supporting the man on the street, I think that's absolutely right. And I kind of call it trickle-down insurance, right? It's like they're trying to ensure that people don't lose their jobs, the living standards are maintained, and the only tools they have to do it are through the financial markets, which is, multiple steps removed from what they end up doing. So I think, and I think circles back to what Rob said, a better system would be to say, what are we trying to ensure? And let's ensure it, and then let the financial markets kind of do their thing, and to kind of step back from, from the Fed having to be the market maker of last resort. And if we decide, actually, no, we need a market maker of last resort because we have an asset-based economy, so we need someone to support markets, then maybe the Fed or central bank should start trying to charge a fair price for that support. Banks have deposit insurance. They have to pay a premium to a deposit insurance fund. You could argue they don't pay enough, but that set aside, that mechanism, that principle is in place. Like they understand they're getting insured and they're paying for that insurance. Well, what about, if the Fed is playing the role of market maker of last resort, they're ensuring liquidity, then financial market participants ought to pay for that. And you could say, well, that's going to mean less liquidity. And I would say, yeah, that will mean less liquidity, but it just means it's more fairly priced. We're subsidizing liquidity, so the central bank subsidizing liquidity, and therefore there's going to be people are going to rely on it more because it's cheaper than it should be. So maybe we can move to a world where we ensure what we care about as a society directly, don't rely on the central bank to do it, and then what the central bank does, have it charge a proper price for it.
Interesting. And actually also I think that if you go back in history, you'll probably find that, we go through these periods where we have strong central banks and weak politicians, and then it reverses and suddenly it's the central banks that's the weak hand. And maybe we just haven't seen that for a while, and perhaps that's coming. Final question, Kevin. Is there going to be a sequel? Let me propose a title, The Fall of Carry. Is that something that you're working on?
It is something that I would like to work on, and Tim and I and Jamie and I have talked about it. So I'm hoping to spend really the next few months, and that my class at Berkeley wraps up in a couple of weeks, to kind of put together an outline for it. And we have talked about that perhaps as the Fall of Carry being the sequel. So I'm hopeful that that'll work out.
Well, I'm not going to claim copyright on that, so you can have it, Kevin. Don't worry.
There'll be an acknowledgement for sure.
Oh yeah, no, of course, I'm sure. So, but excellent. I think we're going to slowly wrap up a fascinating conversation. Kevin, thank you so much for being on the podcast and sharing your thoughts and insights. It's been incredibly interesting to learn about this whole rise of carry and what it really means. And as I said before, it's a must-read book. And I think I told you this as well, Kevin, that I release usually once a year my ultimate guide to the best investment books of all time. And definitely this will be in there, the next issue. Not that it means a lot, but there we are. Any final thoughts you want to leave the audience with, Kevin?
I wanted to say thanks to both you guys. Rob had contacted me when the book came out, and we had some good conversations. And I've listened to your podcast, and I think it's excellent. So I really appreciate you having me on and asking questions and being polite with my long-winded answers. So yeah, no, I think I'll just I'll leave it at that. And I wish you all the best. And I wish you just the right amount of volatility in your portfolio.
Oh, yes. No, absolutely. That's always good to have. So, to all of you listening today, I hope you were able to take something from today's conversation onto your own investment journey. And if you did, please share these episodes with your friends and colleagues and send us a comment to let us know what you want us to bring up in terms of topics on the upcoming conversations with industry leaders in the world of finance and investing. From Rob and me, thanks so much for listening, and we look forward to being back with you on the next episode of Top Traders Unplugged. And in the meantime, go check out the show notes for this episode and all the other resources you could find on the website. And not least, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.